Can you just talk us through what the deficit outlook is? And I think, more importantly, what the implications are for investors. How concerned should we be about this?
Regardless of who wins the White House in November or the composition of Congress going into 2025, the budget deficit is expected to be the biggest loser in this election. But maybe for a different reason than people assume. I think that the expectation is if President Biden gets reelected, we'll see a lot more spending. If President Trump were to get reelected, then we'd see even more tax cuts outside of just the extension of the Trump tax cuts. And I would make the argument that actually that's probably not going to be the case, that the fiscal space to do those things for more spending or for additional tax cuts, again, outside of the extension of the Trump tax cuts, is just going to be relatively limited, because deficits are structurally high. And why is that? Of course, we've seen a real backup in interest rates, so the interest expense is a much bigger portion than it has been historically. But really importantly, Allie, it's sort of the elephant in the room, so to speak, and neither candidate is going to address it, which is just the cost of Social Security and Medicare, particularly as the population ages and as more folks go on these important programs, but likely they're not going to be reformed. And that means that, again, we're probably looking at 5, 6, 7% deficits over the next 10 years before we even talk about additional tax cuts or additional spending. So structurally, because neither candidate is likely to reform Social Security and Medicare, because those things they poll very well, so reform does not poll well, we're expecting that we're going to see quite high deficits. But that leads to your next question, which is, does this matter? And yes, I mean, I think it's, again, a more of a nuanced answer. Does this matter for the markets? PIMCO, other market participants are concerned about the high fiscal deficits and the trajectory of U.S. debt, particularly as a percentage of GDP. But we are not expecting a sort of a Liz Truss moment, if you will. We're not expecting a big sell-off in U.S. Treasuries stemming from a loss of confidence from investors, for instance, and for many reasons. But one reason is because, of course, the U.S. dollar continues to be the reserve currency of the world. And importantly, the U.S. Treasury bond continues to be the reserve asset of the world. And we don't expect those things to change, at least for the foreseeable future. And as a result, while we would expect the market may insist on higher interest rates at the long end of the curve, we're not, again, expecting some sort of loss of confidence or a big backup in rates.